What we're trying to do is have our clients achieve their financial objectives, and in order to do that, we need to figure out what rate of return they need to earn to accomplish their goal. Once we figure that out, we want to try to put together a portfolio that will achieve that rate of return, but do it in the least volatile possible way. And that has two benefits. The first is you actually end up with more money, as I suggested before. The second is when you take the volatility out of a portfolio, it's less likely that the client or we are going to panic and make the wrong decision. And the best example is when you get a severely down market, people tend to abandon their investment program, and typically they do it at just the wrong time. So we want to try to prevent that if we can. We try to think about what returns might be on different investment categories for the next 10 years or so, and when we go through that exercise, we come up with about a 6% annual rate of return on stocks. Also, if we look at a much more diversified portfolio that consists of stocks, bonds, real estate, private equity, hedge funds, and so on, we come up with almost exactly the same projected rate of return, about 6%, but that diversified portfolio should be about 40% less volatile than the pure stock portfolio. So maybe to support that, we should look back through history, and the slide that I showed has 25 years of data, and it shows the return and volatility of an all-stock portfolio, and it shows the return and volatility of a diversified portfolio. And actually, the past 25 years have been almost exactly as I would have predicted. The returns were almost identical. Actually, the diversified portfolio was just a smidgen lower return, but the diversified portfolio had 40% less volatility. So that very much supports the case that we're making going forward. One of the objectives in finance is to get from point A to point B with as little volatility as possible. So in the end of the day, you end up with more money if you have two portfolios that earn the same return, but one is less volatile than the other one. So that's what we're trying to accomplish.